You open your investing app on a random Tuesday afternoon. The market is up. Everyone around you seems to be making money, and without fully understanding why, you buy. Not because you researched the company, not because the price made sense, but because something inside your head said, now is the time. That feeling has a name, and it is costing investors more money than any market crash ever has. Your brain was not built for the stock market. It was built for survival. It was built to notice threats, copy what others are doing, and act fast before the moment passes. For most of human history, those instincts kept you alive. But in the world of investing, those exact same instincts push you to buy at the top, sell at the bottom, and wonder later what went wrong. This is not about intelligence. Some of the smartest people in the world fall into this trap repeatedly. It is about something deeper. The hidden wiring inside your mind that treats a rising stock chart the same way it treats a crowd running toward food. If everyone is moving, your brain tells you to move too. Psychologist Daniel Kahneman spent decades studying why humans make irrational decisions even when they know better. In his research, he described two systems inside your mind. System 1 is fast, automatic, emotional, and instinctive. System 2 is slow, deliberate, analytical, and careful. Investing requires System 2, but when you open your brokerage app and see green numbers and headlines about record highs, System 1 takes over completely. It does not ask questions, it just acts. And the action it pushes you toward almost always comes too late. Think about the last time a stock felt exciting to you. Chances are it was already up 40 or 50% from where it started. The news was celebrating it. People in your office were talking about it. Your social media feed was full of it. That excitement you felt was not an insight. It was a signal that everyone had already noticed the same thing you had. The easy money was already made. This is what researchers call recency bias. Your brain judges the future by looking at the very recent past. If a stock went up last week, your brain believes it will go up next week. If the market has been rising for 6 months, your brain starts to believe it will rise forever. It does not look at fundamentals. It does not calculate value. It looks at the direction of the most recent movement and extrapolates from there. Economist Robert Shiller, who won the Nobel Prize in economics, studied how stories spread through markets. He found that asset prices are heavily influenced not by the underlying business value, but by the narratives investors tell each other. When enough people start sharing the same exciting story about a company or a sector, prices move far beyond what the underlying reality can justify. And by the time that story reaches you through your newsfeed or your cousin's WhatsApp message, you are usually the last person to hear it. Buying on that signal is not investing. It is chasing a story that the market already priced in weeks ago. Now here is where it gets even more interesting. Your brain does not just push you to buy at the wrong time, it pushes you to hold on when you should not and to sell when the timing is worst. Imagine you buy a stock at 500 rupees. It rises to 600 and you feel smart. Then it starts to fall. 550, 500, 470. And instead of reassessing whether you still believe in the company, your brain does something strange. It anchors. The number 500 becomes the reference point your entire emotional experience orbits around. Every price below 500 feels like a loss, even if the stock is still objectively a decent business at 470. This anchoring effect was studied extensively by Daniel Kahneman and his longtime research partner Amos Tversky. They showed that people make decisions not based on absolute outcomes, but relative to a reference point. And the reference point is almost always the price they paid, not the current value, not the future potential, the entry price. So you hold. Because selling below your entry price means admitting you were wrong. And that admission carries more psychological pain than the financial reality of the loss itself. Kahneman and Tversky called this loss aversion. The pain of losing 1,000 rupees is roughly twice as powerful as the pleasure of gaining 1,000 rupees. This asymmetry shapes almost every investing decision you make without you ever noticing. It keeps you frozen in losing positions. It makes you sell winning positions too early. It drives the wrong action at every turn. Here is a real pattern that repeats itself across every market cycle, without exception. When markets rise steadily for a long time, retail investors, ordinary people like you and me, start moving money into stocks. Slowly at first, then with more confidence, then aggressively. By the time markets reach their peak, the largest amount of new money flows in. Everyone finally feels safe, and that collective feeling of safety is precisely when the market is most dangerous. Then the market corrects. Prices fall. And that same wave of retail money flows back out. Selling in panic, locking in losses, moving back to cash just when they should be buying. Behavioral economist Richard Thaler called this pattern of irrational financial behavior a systematic failure of the human mind to separate the emotional experience of money from its rational management. His work on mental accounting showed that people treat money differently depending on how it was earned, where it came from, and what bucket it sits in emotionally. Money made quickly in the market feels different from salary money. That is why people gamble with market profits in ways they never would with their paycheck. And it explains why the same investor who would never spend 20,000 rupees on an impulse purchase will casually buy 20,000 rupees worth of a stock. He barely researched because it was trending on a financial news channel. Warren Buffett has watched this pattern for decades. He has famously said that the stock market is a device for transferring money from the impatient to the patient, not from the uninformed to the informed, from the impatient to the patient. The investors who consistently build wealth are not the ones with the best analytical models or the fastest information. They are the ones who have learned to override the urgency that markets manufacture. They are the ones who made their decision before the excitement hit. They had a plan, a price range, and a thesis, and they stuck to it when the noise told them to do something different. Peter Lynch, who managed the Magellan Fund and produced some of the best long-term returns in mutual fund history, used to say that far more money has been lost by investors preparing for corrections than in the corrections themselves. Think about that for a moment. The anticipation of fear causes more damage than fear itself. Your brain is so good at constructing worst-case scenarios that it pulls you out of perfectly sound investments at the exact moment when patience was the only thing required. So what do you actually do with all of this? The first step is recognizing that excitement is a warning sign, not a buy signal. When a stock feels too good to ignore, when everyone is talking about it, when the chart only goes up, when missing out feels unbearable, that is the moment your System 1 brain has hijacked your financial decision-making. Pause. Not to talk yourself out of every idea, but to shift from System 1 to System 2. Ask yourself one simple question. If this stock were boring, if nobody was talking about it, if the chart looked flat, would I still want to own this business at this price? The second step is to define your own entry before the market creates your urgency. Great investors do not react to the market. They prepare for it. They identify a company they understand, a price at which it makes sense to own it, and then they wait. Sometimes they wait a long time. And when the market eventually gives them that price, usually during a correction or a panic, they buy calmly while everyone around them is selling. Benjamin Graham, who shaped the entire philosophy of value investing, described this process as Mr. Market. He said the market behaves like an erratic business partner who shows up every morning and offers to buy your shares or sell you his at wildly different prices depending on his mood. Most days you ignore him, but occasionally, when he is irrationally depressed and offers you a price far below what the business is actually worth, you take the deal. His emotion is your opportunity. The opposite is also true. When Mr. Market is euphoric and offers you a price far above what the business is worth, that is your signal to be cautious. Not to necessarily sell everything, but to stop buying simply because the momentum feels good. Your brain was built to follow momentum, to run with the herd, to act on urgency. In every other area of human life, those instincts are useful, but the stock market is specifically designed to exploit them. Every piece of financial media, every trending ticker, every green arrow on a screen is triggering the exact response that has historically produced the worst returns. The most expensive habit in investing is not picking the wrong stock. It is picking the right stock at the wrong time. Buying at the peak of excitement, holding through confusion, selling at the depth of despair, and then watching from the sidelines as the market recovers and goes higher without you. Your brain will keep making this offer. It will keep manufacturing urgency. It will keep pointing to the rising price and saying, look, everyone else already knows this. Why don't you? The investors who actually build wealth have learned one thing above everything else. The best time to buy was when it felt wrong. And the worst time to buy was when it felt right. You open your investing app today, the market is up again, everything looks exciting, and now you know exactly what that feeling is trying to do to you.